The mother of all housing bubbles, Canada's housing market bubble is ready to implode. In a recent article by Clary Feinstein, published on August 29, 2023 in the Toronto Star, Philip Colmar, the managing partner and global strategist at research firm MRB Partners, raises a red flag regarding Canada's housing market, suggesting that the country could be on the brink of experiencing the largest housing bubble in history. Colmar, an expert who has extensively studied housing bubbles on a global scale, points out several key factors that contribute to his concerns. These factors shed light on the potential consequences of such a bubble burst for Canada's economy and its citizens. One of the foremost issues that Colmar highlights is the significant surge in house prices that Canada has witnessed since the 1980s. While rising property values are a common trend in many housing markets, the alarming aspect in Canada is the pace at which these prices have outstripped income growth. This has created a stark imbalance between housing affordability and household incomes. The result is that many Canadians are finding themselves priced out of the housing market, especially in major metropolitan areas where the cost of living is already high. Colmar points to another critical factor: the extended period of historically low interest rates that Canada has experienced since the aftermath of the 2008 financial crisis. While low interest rates can stimulate economic activity and borrowing, they can also create a situation where individuals and businesses become overly reliant on cheap credit. Canada's sustained low interest rates over the years have led to a scenario in which consumers have taken on substantial debt to finance real estate purchases and other expenses. This trend has contributed to what Colmar terms over-leveraging, where Canadians are shouldering a disproportionately heavy burden of debt relative to their income levels. The strategist highlights the Bank of Canada's efforts to curb inflation by significantly raising interest rates, which have jumped by almost 5 percentage points since March 2022, with the overnight rate reaching a 22-year high of 5%. The central bank's actions are an attempt to counterbalance the overheating economy. While such measures are intended to prevent an economic bubble from growing larger and more unstable, they can also have adverse effects, such as putting pressure on heavily indebted households. As interest rates rise, the cost of servicing mortgages and other debts increases, potentially leading to financial strain for many Canadians. Colmar's analysis delves into the comparative debt levels between Canada and the United States. He notes that the average Canadian household carries a staggering debt load of around $1.87 for every dollar of disposable income. In contrast, the average U.S. household owes only $1.01 for every dollar of disposable income. This disparity underscores the severity of Canada's debt situation, which is largely tied to the country's skyrocketing home prices. The correlation between home price growth and high levels of debt becomes particularly concerning when considering the potential consequences of a housing bubble burst. The article also addresses the unique circumstances that have contributed to Canada's current housing bubble scenario. Colmar explains that Canada has enjoyed a greater population growth compared to the U.S., which has further driven housing demand and, subsequently, prices. Additionally, Canada experienced less significant fallout from the 2008 financial crisis than the U.S., leading to a more favorable environment for mortgage borrowing. However, this also means that Canada's economy and its citizens are more vulnerable to the impacts of a housing market correction. The article delves into the impact of the COVID-19 pandemic on Canada's housing market dynamics. With interest rates at historic lows for an extended period during the pandemic, many Canadians were enticed to enter the housing market, despite the already elevated prices. The rush of demand further inflated home prices and led to a surge in new mortgages. However, the concern lies in the fact that those who purchased homes during this period are now facing the prospect of renewing their mortgages at considerably higher interest rates. This situation could lead to financial strain for households, potentially causing some to default on their mortgages. Colmar also touches on the potential timeline for the housing bubble to burst. He suggests that the trigger for a bubble burst could be a recession coupled with significant job losses. Already, There are signs of economic stress as consumer spending slows and unemployment begins to tick upwards. The Canada Mortgage and Housing Corp. has issued warnings that the country's high debt levels make it ill-prepared to weather a recession. Colmar believes that a housing market correction will be inevitable, leading to a substantial drop in home prices as they revert to more sustainable levels. Moreover, Colmar explains that Canada's economy has a significant portion of its economic activity closely tied to the housing sector. This includes jobs in real estate, housing construction, and related industries. Therefore, if the housing bubble bursts, the negative ripple effects could extend beyond the housing market itself, affecting employment and economic growth across various sectors. Despite the grim outlook, Colmar points out a potential silver lining. If the housing market does experience a correction, it could lead to increased affordability for prospective buyers who have struggled to enter the market due to inflated prices. This could potentially rebalance the housing market and create opportunities for a new wave of homeownership. Philip Colmar's assessment of Canada's housing market presents a cautionary tale. The combination of soaring home prices, heavy debt burdens, and a prolonged period of low interest rates has created an environment that is ripe for a housing bubble burst. While the exact timing and magnitude of such an event remain uncertain, Colmar's analysis suggests that Canada's economy and its citizens could face significant challenges in the coming years, as policymakers and market participants grapple with these issues. The hope is that prudent measures will be taken to mitigate the risks and navigate a potential housing market correction in a way that minimizes harm to the broader economy and the livelihoods of Canadians. The previous article describes a complex web of economic and market factors that could potentially lead to a meltdown of significant proportions. To delve into the possible scenarios that could trigger such a meltdown, it's important to consider both the macroeconomic factors at play and the dynamics within the Canadian mortgage and housing markets. 1. Unsustainable price growth and overvaluation. One of the key factors contributing to the potential housing market meltdown is the rapid and unsustainable growth of housing prices over the past few decades. As highlighted by Colmar, Canadian house prices have far outpaced income growth, leading to a situation where affordability has become a major challenge for potential homebuyers. This creates an environment where a growing portion of the population is unable to enter the housing market, potentially leading to reduced demand and a correction in prices. 2. High levels of household debt. The prolonged period of low interest rates since the 2008 financial crisis has encouraged Canadians to take on significant levels of debt, particularly in the form of mortgages. This debt burden is a major concern because, as interest rates rise, the cost of servicing these debts also increases. This could lead to financial stress for many households, potentially causing a surge in mortgage defaults. Such defaults could lead to distressed property sales, further depressing home prices. 3. Impact of rising interest rates. The Bank of Canada's decision to raise interest rates significantly to combat inflation adds another layer of complexity to the situation. Higher interest rates directly affect mortgage rates, making borrowing more expensive. This could potentially lead to reduced demand for housing, as affordability continues to erode. Higher rates also increase the cost of servicing existing debt, putting further strain on households already carrying high levels of debt. 4. Economic downturn and job losses. A significant economic downturn, potentially triggered by global or domestic factors, could lead to job losses and reduced consumer spending. As Colmar suggests, the combination of a recession and sizable job losses could be a trigger for the housing bubble to burst. Reduced consumer spending and economic uncertainty could lead to decreased demand for housing, pushing prices downward. 5. Mortgage renewal challenges. The influx of homebuyers during the COVID-19 pandemic, lured by historically low interest rates, sets the stage for future challenges. As these mortgages come up for renewal, many homeowners may find themselves facing significantly higher interest rates. This could result in increased mortgage payments that some households may struggle to afford, potentially leading to defaults and foreclosures. 6. Excessive speculation and investor behavior. If the housing market becomes increasingly driven by speculative behavior rather than genuine housing demand, it could lead to artificial price inflation. If investors and speculators begin to exit the market en masse due to concerns about a potential bubble burst, it could trigger a cascade of selling activity and drive prices downward. 7. External shocks and market sentiment. Global economic events, such as geopolitical tensions or shifts in international trade dynamics, could impact the Canadian economy and housing market. Negative market sentiment fueled by such events could erode consumer confidence and lead to reduced housing demand. In summary, a potential meltdown of the Canadian housing market is not far-fetched given the intricate interplay of factors: unsustainable price growth, high levels of household debt, rising interest rates, economic downturns, mortgage renewal challenges, speculative behavior, and external shocks collectively create an environment where the housing market is susceptible to correction. While the exact trigger and timing remain uncertain, the warnings from experts like Colmar underscore the need for prudent economic management, regulatory measures, and careful consideration of the long-term consequences of market dynamics. Balancing the interests of homeowners, potential buyers, and the broader economy will be crucial in navigating the complexities of the Canadian housing market and preventing a meltdown of epic proportions. What do you think? Are Canadians in for an epic housing market meltdown where forced selling, foreclosures and loss of equity will be the norm over the next several years? Please join in on the conversation by leaving a comment. If you found this video and information useful, please smash the subscribe button and hit the notification bell so we can keep providing you with timely information you can apply on a daily basis.